This session is called The 6 Questions Your Board Needs to Ask About Investments. We may have more than 6 questions that need to be asked, but really it's what should a board or an investment committee ask its investment team when they actually sit in the meetings, and how do we get better outcomes? What I'd like to do now is, once you've taken that all in, is to ask a few questions of our panellists, and just to get their experiences and their views about how they have, I guess, comment on what they consider to be the main challenges to decision making that they face in their roles as CIO in Ben's case, but also to Judith in her current role as a committee member of an investment committee at Lucraft, but also when she was on the other side of the table working in private equity and presenting to committees and boards herself. So Judith?
I guess my comments will come from a sort of a range of experiences over far longer than I wish to really mention, but I think one of the enduring things is actually understanding the environment, having a clear understanding of the situation in which the committee's meeting, what the structure is, what their frameworks, what their beliefs are, how they go about making decisions, and what the resourcing and supporting is, and what the underlying governance and delegations is. And I think, you know, clarity on those things and a common sense of purpose, common understanding of what that committee is trying to achieve and the end objectives, I think is pretty important to starting the journey of any sort of committee or board or whatever, trying to make sort of consistent and long standing sensible decisions.
Ben?
Thanks, Paul. I should probably open by saying that a good illustration of the evolution of investment decision-making processes, I actually advised King's College in Cambridge in the UK in a previous life, and Keynes was the bursar of King's some time ago, obviously. But they still have all his records in the archives, and apparently what he used to do was wake up on a Monday morning, sit in bed, look at the portfolio and decide what his trades for the week were going to be, and they'd go and do it, and then he'd come back after the weekend, sit in bed the next Monday morning, look at the portfolio. So,
did that process inspire you?
Well, from all accounts, it actually, his period of oversight was one of quite good performance, so perhaps there's something in that. But certainly come a long way since then, since an individual sitting in bed looking at the portfolio and making decisions. In terms of the challenges that in my current experience, GESB's quite specific in what its framework has become and is now, and that's really focusing on value for money. And I think, obviously that's a very strong theme through this conference. But I think we're probably quite prepared to say we do have a fee budget. I don't think we want to be too explicit on what it is. I think because you need to be, it shouldn't be a constraint as such, but what it imposes is discipline to have a very high threshold of conviction that when you take a decision, there will be a positive reward for members for the cost and risk that you take. So that's sort of overarching in our thinking. I suppose GESB's a fairly traditional approach in terms of we look at the long term via the strategic asset mix, we look at the medium term through how we tilt away from that asset mix, and we look at manager selection. So implicit to that is a very degree of faith in the long term asset mix. That's I think that's the first step of the process, is we have faith in that combination of assets to deliver the objective with a high degree of confidence. So any departure from that policy has to be robustly justified as giving a high degree of conviction that there's going to be a reward for doing that. And that's at asset allocation level and manager selection level. You notice I didn't mention the short term. The short term, we're not in a position to really trade around the short term, but all the short term does is tells us whether we need to reassess our expectations of the medium term. It's just a price signal that changes in the short term. Our emphasis is very much in the medium to long term. But in terms of the challenge, I think it's what we're working through at the moment is presenting and providing the information to the committee and the board that reflects that requirement. And it's in terms of delivering those high conviction, evidence-based views that facilitates a decision to be made. So it's great to have the philosophy, and that's needed. However, I think the challenge was really to present the information and determine the processes by which those requirements can be met in order to facilitate a decision.
Thanks, Ben. So we've just seen a video that demonstrates divergent worldviews. To what extent do you think that your personal worldview impacts how you arrive at decisions about investment markets and associated strategies? And can an investment committee operate where different members' worldviews, or where members' worldviews differ? Judith.
Well, I think we're all the sum total of all our experiences, and we all have our biases and areas where we've been influenced by past decisions made or success or otherwise. So I think when you come to any decision-making process, you need to sort of be mindful of all those sort of things that come with you, and everybody brings something of that order, and everybody's going to have a different view on various things on any sort of structure or committee. And I mean, that's part of the power of a committee, is to harness those views to end up with, you know, hopefully a better outcome than any one individual. Otherwise we'd just be, you know, one individual making these decisions. So, you know, I think that you can harness a lot of benefit from having, you know, different views around the table. If you start off with sort of your organisation or your committee formulating its own views and beliefs about what it's there for, what it's trying to achieve, etc., if there are substantially sort of very divergent views at a fundamental level, well, hopefully they'd be sort of addressed in some of those earlier discussions, and they wouldn't just suddenly pop out when you're just looking at one investment opportunity at some point in time, and suddenly, you know, you've got this sort of surprising situation. But I think you need to be prepared to sort of discuss things, work through things, you know, test the arguments from different perspectives, and work through it. And, you know, I think having different perspectives and views, that's what committees, that's what boards are all about, and it's trying to work through to a cogent conclusion on the matter that's in front of them.
So on that basis, so to Ben, so it's about the nature of the argument possibly. So if we know that investment markets can only be true markets when there are buyers and sellers with imperfect information, hence an investment idea is normally accompanied by arguments both for and against. You know, there are a range of argument styles. So I want to briefly describe each of them, and there we are there in the triangle. You just want to describe, you know, how you present an argument, and how in your experience possibly the discussion goes to reach a conclusion. So we can see here, sorry, at the top of the triangle, where you're really sort of explicitly discussing the point and what the core discussion is, and refuting it, and working all the way down through to the bottom one, which is name calling. And there are a number of different approaches in between. How do you see the discussion, how robust discussions are, and do they focus on the central point to reach a conclusion or not? Or do personalities come into play and other aspects which move away from what the core point is that's being made?
There's always an element of personality. I think that's part of the vibrancy of having a multi-person committee. But thankfully, in my experience, the discussion and approach is more centred towards the top of that triangle. Thankfully, I haven't been in an environment where there's been quotes such as the one on the bottom, or things have descended to name calling. But I think there's two aspects, I think. One is I think a good, robust process and a good board or committee has different worldviews or different biases, for want of a better term, but also a good investor will be aware of their biases, will avoid confirmation bias, in other words, only sourcing information that reflects their worldview, and discounting information that doesn't reflect their worldview. I think they should be cognizant of the potential risk in biases, and what I mean by that is if you have a particular worldview, I think you're more likely to approve or implement something that you're fundamentally aligned with, and perhaps not subject that decision or that process to the same amount of rigour that you might otherwise. So I think, again, a good committee will have divergent or potentially differing worldviews, but be aware of biases, and always seek out the counter-argument. You know, look at the state of the world under which a decision will be a positive one. Look at states of the world under which a decision will not be a positive one, and be aware of those and make an informed decision. I also think there's an element of process that can avoid, you know, descending into the less robust forms of argument. So it may well be that an investment process or a committee, you know, the way a committee or board considers decisions is to quite explicitly cover, you know, almost a SWOT type analysis. Look at the argument for, look at the argument against, look at the risks inherent, look at the conditions that are required for it to be a good and a bad decision. So you can, in terms of the process, you can almost take away, you know, the arguments or the, you know, there's always an element of some people on a board or committee that are perhaps more prominent in the discussion, more vocal. If you just address, you know, those robust aspects through the process itself, you know, you don't have to have a situation where perhaps people won't speak up. It's built in as part of the process.
Yeah, I think that's a very good point. I think the bottom parts of your triangle are a bit more in the category of tantrums rather than argument, but I think the point about making sure all the voices around the table are heard is pretty important, and in fact, thinking about this discussion led me to reflect on prior places and prior times and prior experiences. And one that did come to mind was a long time ago when the Soviet Union was falling apart. And I remember being in an investment committee, and there'd been, I can't remember exactly the incident, but it looked like it was all off and there was going to be a military coup, and the organisation I was working with was thinking about how to protect its, you know, offshore investments, etc., etc. And the whole room was absolutely convinced it was all over and it was just going to be dead in the water. And they decided to make some changes to their strategy, and the details I don't particularly remember. But I do remember sitting in the room and saying, well, what happened? Why do you think it's going to happen? Because this is sort of like the last gasp for people there, and maybe they'll get out in the streets and, you know, stop this happening. And anyway, so they went ahead and down the path that it was going to happen. And then it didn't happen because people did get out on the streets apparently, and it didn't end up in that situation. So we did a review of it, and everybody was saying, well, why did we do it? Why did we do it? And then somebody said, well, and someone said, well, there's no voices against it. And then someone said, well, yes, there was. Judith said that. But, you know, I was quite junior and I didn't push it. I just had that contribution, and it always sort of stuck with me that if you've got something to say, you probably should try and make sure that you have people listen to it. And secondly, if you're orchestrating a meeting on issues, you should make sure that everybody's got the opportunity to share their views, and they may not be relevant, or they may be very worthwhile and sort of considered and important. So I just think that process in a meeting is really important, and that just because loud voices are there doesn't mean they're the right voices always. And I think it is just important to be really respectful of getting all the views that are available, and, you know, thoughtfully considering them.
And I think it's important to recognise where worldviews impact on the portfolio. But some examples from this week. I remember, you know, listening to hedge fund managers in Europe in sort of 2009, 2010. One in particular was particularly vociferous, and he was out there saying, beta is dead, it's all over, you know, just as the market goes on an absolutely rampaging rally for 3 or 5 years. Similarly, at the moment, we're seeing, you know, quite rightly, concerns about the very low yield environment in the fixed income side. I'm not disputing the reality of current valuations. However, I think it's important to keep in mind what's the long-term perspective and what's the medium-term perspective, and not confuse the two. And I think we've seen, and Gesby included, have quite rightly, I think, in the environment, moved away from more, you know, index-aware duration-focused strategies into more absolute return fixed income type strategies. I just think it's important to acknowledge whether that's a long-term position or if it's a medium-term position. So if you know, again, it comes down to process. If you change your strategic asset allocation to reflect that, you've got to be cognizant that, you know, that's effectively reflecting the decision that you think that the long-term fundamental characteristics of fixed income markets have changed. I think it's very dangerous to do that. And I agree, I think there was a PIMCO presentation I saw yesterday that it's completely plausible and rational to expect the foreseeable returns, given current valuations, to be lower than average. But if we see a particularly strong backup in yields over the next few years, then the prospective outlook from there becomes much more aligned with long-term averages. So I think you need to be aware, you know, always cognizant of what is a long-term position. When you're deviating away from that, does it reflect a fundamental change in the opportunity set, or is it more around current market environment?
So, in fact, following on from that, so worldviews can fundamentally change over time, and they do, and it can happen over relatively short periods. To what extent do you rely upon the past as a guide to the future, and what do you use as evidence, an evidence base for your views when you're presenting, Judith?
Well, I think the past is always a useful guide because. I think somebody said if you don't understand history, you're destined to repeat it. So I think it's always important to understand the past, understand your context, and look for the sort of evidence and the range of evidence and the countervailing views that could be put on that evidence. Because markets are all about differing opinions and differing views, and often you can make good arguments for quite different positions and views, and at the end of the day you have to rest somewhere. So I think it's very important just to have good processes and good quality inputs, and have everyone sort of trying to work to the same outcome, and be prepared to test the pathway that you're looking to take.
And Ben?
I think it's particularly interesting because we've got regulators that tell us to not rely on past performance as an indicator of future performance. For example, we've got a pretty widely accepted sort of approach in the consulting industry where you need 3 years of track record to sort of be looked at, and I would argue that 36 months of data is virtually statistically insignificant. But in terms of evidence you need, it's a very difficult one to answer. I think all investment decisions, certainly from our perspective at present, are balancing some form of short-term tolerance with some form of long-term reward, and that applies at the strategic level. Constructing an SAA, you're looking at short-term variability and comfort with that. And trading that off against a longer-term return expectation. Similarly, when you make an active asset allocation decision around that, you're looking at a degree of active risk that derives from that, and comfort levels with that, and an expectation that it will add value over the medium to long term. Same thing applies with manager selection. It's about giving a manager a degree of active risk and expecting a reward for that over the long term, but also being comfortable with what sort of variability that might introduce in the short term. In terms of the evidence we look for, again, statistically, I think, as I said sort of at the outset, we're looking for evidence of reward for cost and skill. So obviously, we're quite focused at a manager selection level on things like the information ratio. We also look at active share. I think that's a good measure of validating that managers are using their risk budget. Ex-ante tracking error is one thing, but I think quantifying the magnitude of difference in a portfolio to the market is useful. But I think that there's generally pretty lacking evidence. A lot of those metrics are based on relatively short time frames. I think we've all seen track records that are long-term look very good, but when you break them down, a lot of that long-term return may have come from a particular period in time when perhaps the manager didn't have the same amount of assets, or there was a particular market environment. We certainly try and understand market environments in which, this almost goes back to the conditions under which things will work and not. Understanding market environments that would tend to favour and not favour a strategy. And this all comes down again to making informed decisions, understanding reasonable expectations, and as a byproduct of that, you give credit where credit's due and you don't assign credit where it's really not warranted. So if a high beta manager's outperforming in a bull market, you know, is that something to really give him credit for, or a value manager, you know, when the market's conducive. One thing I think would be interesting is we tend to just look at, as evidence, you know, monthly return streams, for example. I don't know of any sort of consultants, but it would be more useful to, and perhaps this is being done, for managers to keep track of their positions on a monthly basis, their fundamental characteristics, you know, their PE ratios, their price-book ratios, for example, their active shares, so they can, instead of presenting to you a performance track record, they can present to you, look, this is how we've positioned the portfolio through time. These are environments where it's worked and where it hasn't worked, but you know, the key thing for me is about being true to label, because the last thing you want to do is employ a manager on an expectation that they'll be employing a strategy, and then in some market environment they depart from that. But I think, in summary, I think that there's a lot of evidence lacking. Obviously, longer term evidence is probably more weighty, but all that in the mix, I think, makes it for, you know, certainly from our perspective, is a pretty high threshold to have conviction in a particular outcome.
Okay, so Judith, just on that, so Ben was saying that sometimes evidence is lacking, and it may not be, the argument may not rely solely on an evidence base. So therefore, to sort of fill the gap, is it a function of, you know, the quality of the argument or the quality of your beliefs and how well the idea is presented to the committee or the board?
I think it's clearly you look to evidence as far as it can take you, but at the same time, you have to have a forward view to frame what you're trying to achieve. And at the end of the day, any decision has an element of judgment in it, and it's about understanding what things you're making judgments on which aren't perhaps, you know, fully supported by evidence or dependent on particular views, and how then you can monitor that for the effectiveness or not of the path that you're looking to take, and understand, you know, the pluses and minuses around that. And I think it's sort of trying to be robust and, you know, clear about that, which is pretty important.
Yep, thanks for that. So, I mean, one of the issues is that information changes. We work in a dynamic environment. Investment markets are dynamic. Information flow is dynamic. There's lots of noise, but possibly real information does change over time, and it can also be about how you take on that information and filter it through your own lens, and do you actually change your decision, or do you actually take that information on and possibly retain your original decision, or you do change. So we've got a problem here. Have a look at that. We've brought some donkeys into, is that a goat, into the ASI, again a first for ASI. It's called the Monty Hall problem. I don't know if any of you do know that, but it's about how well equipped we are to make decisions based on data that needs to be processed. Does it have meaning? And it's a probability-based. There's going to be a show of hands for this as well. So it's really let's have a look at the problem. It's really about, it's a brain teaser in the form of a probability puzzle. It's loosely based on a TV show in the US called Let's Make a Deal. Fantastic daytime TV if you get a chance to watch it. And it's based on the original host by the name of Monty Hall. So assuming you've got 3 doors, you're ready to get the big prize, which is a car. So you've got a car behind one door and a goat behind each of 2 other doors. I'll make the assumption straight off that you do want to win the car. In this, so let's just work on that. So if you choose, so for example, you choose door number 1, you've got, you know, a 1/3 chance of getting it right. But just say the host opens up one of the other doors, say door 3. So we've got here, sorry, on this example, I've picked door 3. The host goes and picks door 1 and shows that there's a goat behind door 1. So what we've got left is, behind doors 2 and 3, a goat or a car. Still working on the premise that we want the car. What would you do? So put your hand up if you believe that you still keep the choice of door 3, who wants to retain door 3? Oh, that's probably about half, but then my maths is not so good. Who would change to door 2 on the basis of that? That's about a third, so there's a few who are unsure. There's a couple of double hands there. The issue is really about having been provided more information, would that, and filtering that information, would you still retain the decision that you've made because nothing's actually changed? What's behind those doors is still the same. Or having known what's behind door 1, being a goat, that you would change your mind and go for door 2, where hopefully there's a car. And the answer is that if you changed your mind and went for door 2, there'd be a 2/3 likelihood of getting the car and a 1/3 likelihood of getting the car behind door 3, your original choice. The general premise, the general history of this has been that there are a lot of PhDs, the maths professors that came out and said, actually, no, it shouldn't make any difference, but in fact it does. So what this leads to is whether, as information changes and it comes through, does your information change? Are you flexible enough and able to adapt to the change in information, how you present to an investment committee and the board? And conversely, is the board able to take on new information, or are there biases and their original beliefs? We're actually not going to do this at the end of the show, by the end of the presentation, by the way. Or are boards and committees so beholden to their original views that they're unable to change, even if they're presented with more information or more compelling information that would lead them to a higher likelihood of a better decision at the end of the day? So I guess the question then to follow up through is to both Judith and Ben, what's your experience with presenting a compelling argument that has enabled a board or a committee to ultimately change their mind based on the evidence or the quality of the argument to get an outcome that ultimately leads to better decision being made?
Do you want to go?
Experience of changing your mind. Not so much changing mind, but I think a good example of the importance of my sort of general view is you should approach every day with almost a clean sheet of paper. You shouldn't be too wedded to legacy views and positions. So, I find it curious when I hear that people, for example, if you have an active asset allocation position that has or hasn't worked in a period of measurement, you don't want to be biased by where you currently are. You need to come with a fresh sheet of paper and say, as at today, and the information the market's giving today, do we still want to maintain that position? And a good example was, I remember sitting on a committee in London in 2009, March 2009, I think it was actually Friday the 9th or thereabouts. It was, just by pure coincidence, was pretty much the absolute bottom of the market. And so this goes to having a process that facilitates multiple and differing views, and also being pretty unemotional and pretty unwedded to what happened yesterday and just starting again, looking at things with a fresh set of eyes each day. And so the committee in question had been underweight equities since late 2007, which was great. The question facing the committee on this day in March 2009 was, what do we do? Do we stay underweight? Do we neutralise? Do we, And there was, and this is another aspect of, we all sort of observe retail, what we sort of generally call retail investor behaviour, and like to think that as professional investors or institutional investors we can somehow rise above that. But I remember the absolute doom around the table in March 2009, and just the expectation generally that it wasn't over yet. It was going to halve again. It was the S&P was going to 300 or 400. It was quite remarkable, just the doom. And I put a view forward that I think we should neutralise our underweight equities. And it had absolutely nothing to do with a view of the future. It had absolutely nothing to do with saying equities are going to rally from here. What it had to do with was saying, we've just achieved excess returns over the past 12 or 18 months, 2 to 3 standard deviations, what we should expect. It's not plausible to really expect that to continue. So just on the basis of almost just saying, look, let's just lock in some of that outperformance versus a benchmark, admittedly, returns were still down, but let's just lock in some of that relative performance. The second thing was, the one thing that we knew with some confidence was the S&P at 700 was closer to the bottom than it was at 12 or 1500. So let's, again, just start with a clean sheet of paper. As at today, with market pricing and market information, do you still want to maintain that bias? Needless to say, another example of some voices being stronger than others, the position wasn't adopted. They remained underweight equities and then obviously were underweight all through the bull run as well, and later had to come back and revisit and probably added to equities and neutralise the position at much higher levels. But I just want to emphasise it had nothing to do with a future expectation. It wasn't, you know, a market view that said equity's going to rally from here or we're at the bottom. It was simply reassessing the position, acknowledging what it had done already, and just simply taking a view on fairly pragmatic sort of metrics that let's take that position off as at today's pricing. Thanks,
Ben. And Judith, and we've got one question here. Please send more questions through. And I guess one of the issues, just to extend Ben's comments, is about possible personal reputational risk. How do you see that play out as well in terms of decision making in a committee or board meeting where personal reputation may override a quality decision because people are concerned about what the impact may be on either themselves, the board, or the organisation more generally?
For reversing a decision.
Just for making a decision or not making a decision.
Well, I think you have to, first of all, you know, go back to why you're there, and it's about whatever the outcome that's appropriate for the task that you're doing, and whether, you know, ultimately back to the members or the investors or whatever the source is, that, you know, that's your obligation. And so you need to be able to sort of think through issues in a clear and rational way. And, you know, in the example that Ben was talking about, sort of, you know, thinking through for that committee, why did they take that position in the first place? Is it still sort of valid? And does it make sense to continue that given what they've experienced, which has been a pretty extreme sort of set of circumstances? And I think at those sorts of junctures, you need to be able to sit and very calmly sort of assess things and balance up where you're sitting versus the risks and rewards you thought you had, where you are today and what they might look like in the future. And, you know, sometimes it is difficult to be, you know, perhaps thinking that something that's been in place that, you know, as part of what you've supported needs to be changed. But that's what you paid, that's what you're there for, is to be able to make those adjustments. And I think that's the important thing to keep in mind. And, you know, it's pretty important, I think, to just be able to put those issues aside and address the task as it sits there on that day and not bring too much sort of past history on that front.